For decades, there was this one simple investment strategy that was, well, the very definition of safe. But then 2022 happened, and it failed catastrophically. So today, we're going forensic. We're conducting an autopsy to figure out exactly why this trusted approach to money is broken. Let's begin the examination. To really get to the bottom of this, we have to treat it like a proper investigation. We need to look past the headlines and really examine the underlying cause of death for what was, not too long ago, the most reliable portfolio in finance.
All right, so who's our patient on the table? It's the once undisputed champion of smart, prudent investing, the balanced portfolio. For an entire generation of investors, this was the bedrock. It was the foundation of financial planning, a strategy that felt almost guaranteed to work.
And at the very heart of this thing was the classic 60-40 portfolio. It's such a beautifully simple idea, right? You put 60% of your money in stocks to get that growth, and the other 40% in safe government bonds to act as a stable cushion. The real magic, though, was in how those two parts were supposed to dance together.
And this is where the sheer elegance of the whole idea really shines through. The theory was that stocks and bonds had this inverse relationship. So when a recession hit or the market panicked, stocks would tank, but investors, running for safety, would pile into government bonds, and that would push their prices up. The gains on your bonds would soften the blow from the losses on your stocks. It sounds perfect, right?
And look, this wasn't just some nice theory on a whiteboard. It was backed up by 3 decades of cold, hard data. Just look at this table. From 1990 all the way to 2020, the correlation between stocks and bonds was negative. They consistently moved in opposite directions. And here's the kicker. During a crisis, that negative correlation got even stronger. It was the perfect hedge. You got an 8% return year after year with a built-in shock absorber. It's no wonder everybody trusted it. Okay, so that brings us to the scene of the crime, the year 2022. This was the year the fundamental physics of safe investing just seemed to break down completely, and it left millions of investors totally exposed. And wow, this chart right here, this is Exhibit A in our autopsy. This is the smoking gun. In 2022, stocks, the S&P 500, fell almost 20%. Okay, bad, but not unheard of. But look at the bonds. They fell 13% too. The so-called safe part of the portfolio, the cushion, it wasn't safe at all. And the result? The classic 60-40 got absolutely crushed, down nearly 18%. To really put this in perspective, you have to understand. This was the worst year for the strategy since the Great Depression. The central promise of the 60-40, that when one thing zigs, the other zags, it was completely shattered. They both fell, and they fell hard, at the exact same time. Okay, so we know what happened. But the big question, the one our whole autopsy hinges on, is why? What was the specific mechanism of failure? What was the actual cause of death here? And the answer is, it's kind of shocking in its simplicity. That beautiful, elegant, inverse relationship we talked about, the one that made the whole thing work, it didn't just get a little shaky. It completely flipped on its head. Get a load of this number. During the worst parts of 2022, that stock-bond correlation hit positive 0.80. Let me translate that for you. It means they were moving almost in perfect lockstep. Your cushion wasn't a cushion at all. It was an anchor, dragging the whole portfolio down even faster. So you're probably asking, why? Why did it flip? Well, it's because we're not playing the same game anymore. The whole economic world shifted. For 30 years, we lived in what you could call a demand shock world. When the economy got weak, central banks would cut interest rates to fire up demand. Bad for stocks, but great for bonds. But in 2022, we slammed headfirst into an inflation shock world. Soaring inflation forced central banks to jack up interest rates, which is basically poison for both stocks and bonds. The rules of the game had fundamentally changed. Okay, so you know what they always say after a bad year, right? Just hang in there. Be patient. It'll bounce back. Well, here's the thing. The evidence is telling us that this time, that advice isn't just a little off. It could be flat out dangerous. You see, for decades, investors like us were trained to expect a very specific, very reliable pattern. A crisis hits, the central banks ride to the rescue with lower rates and stimulus, and then the markets recover. It worked after the dot-com bust, it worked after 2008, it even worked after the COVID crash. Buy the dip became a mantra for a reason, because the playbook always worked. But that playbook, it's torn to shreds now, and here's why. Central banks can't just slash rates to zero when inflation is running hot. Governments are absolutely buried in debt, so those huge spending packages are pretty much off the table. Basically, the cavalry that we could always count on to save the day, they're out of ammunition.
And this has some really profound, kind of sobering implications for what comes next. Look at this. Major asset managers are all basically saying the same thing. The 60/40 portfolio is probably only going to return about 4% a year for the next decade. That's half its historical average. And once you factor in inflation, your real return, what you actually make, could be scraping zero. Your safe portfolio is now a path to slowly losing purchasing power.
All right, so the autopsy is done. The verdict is in. The old world of safe money, it's gone. And that means we need a completely new way of thinking, a whole new mental model for how markets work in this brand new environment. In the old world, we thought of volatility as just noise, right? It was this annoying thing you had to avoid or just grit your teeth and endure. But the new way of thinking, it's a total paradigm shift. It sees volatility as energy. It's not something to hide from, but a fundamental force in the market that you can actually understand, navigate, and maybe even harvest for returns. Okay, so how on earth do you harvest energy from the market? Well, it comes down to this really fascinating concept called the volatility risk premium, or VRP. The simplest way to think about it is like an insurance premium for the entire market. It's the gap between how much chaos the market expects versus how much chaos actually happens. And here's the secret. On average, the market consistently overestimates the future danger. Here's what that means in plain English. You can basically become the insurance company for a market that is constantly, systemically over-insuring itself against risk. By selling that insurance through things like options, you can collect the premium that all those other fearful investors are willing to pay for protection. You're getting paid for the market's chronic anxiety. And this really gets to the heart of the decision investors face now. The source material puts it just perfectly. If you adapt to this new world and it turns out you're wrong, the cost is pretty modest. But if you just cling to the old rules and assume the 60/40 is magically going to start working again, when everything has changed, the cost could be severe. So that's it. The autopsy is complete. The cause of death is clear. And the evidence is overwhelming that the patient isn't coming back to life. And it leaves every single one of us with a really important question. Is your portfolio built for the world that was, or is it built for the very different world that is?